Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David, how are you?
Hello, I'm good, thank you. I'm hoping that this is our last little blip of excitement before Christmas.
Yeah, I know. I thought we were going to have kind of plain sailing to the end of the year, but it appears not, because there's lots of things happening at the moment. And we're going to touch on a couple of them, aren't we, today, as best we can.
Yeah, we are. But before we do that, should we do our numbers round?
Yeah, definitely. What's yours? You go first.
Mine is 1951. Now, obviously, that's a date. Do you care to guess a wild stab in the dark, or do you want me to enlighten you?
No, I'm not even going to make a wild stab in the dark. You tell me.
Okay, I'm risking sailing right into the world of Apocrypha here, but I will do it. I'll do it anyway. 1951 is the earliest known use of the term Black Friday, which apparently referred to the day after Thanksgiving. And it was its earliest reference is in the journal Factory Management and Maintenance, which I'm sure you're a subscriber to.
Yeah, not as much as I used to, no.
Well, in that journal, it referred to the practice of workers calling in sick the day after Thanksgiving. Now, the reason I said I'm straying into the world of Apocrypha, that is just one possible explanation for the term. The other explanation was a term coined by I think, Philadelphia police force that described the traffic in Philly and Rochester around the time after Thanksgiving, where everyone went out shopping in that period in the run-up to Christmas.
Okay. Well, mine is also a date. It's 1962, and it's very topical.
Okay. Very topical. It's a political date.
It is a political date, yes.
Okay, come on. What is it?
It is the last, and at the time of recording, the only successful motion of no confidence in the French government in the Fifth Republic.
There you go.
Now, as we're recording, there is a debate going on in the French Parliament. There may or may not be a vote of no confidence in Barnier. We'll know once this podcast is up and you're listening to it. But it's one of the topics we're going to be covering. We've got a bit of a mixed bag today, haven't we? We are going to be talking about French politics and the impact, I guess, on markets, particularly bond markets. But what else do we want to talk about?
Well, just on that point, I feel like we should set some rules for Need to Know. I think the first sensible rule is let's not work with animals. That's always a good rule. Yeah. And the second rule is not to discuss any live political event as it's unfolding at the risk of us talking for 20 to 30 minutes and then having to immediately delete it and start again. Yeah. So we'll just throw caution to the wind and discuss it, shall we? So that will be our first topic. Let's talk about France, and I think we should talk about France in the context of what the bond market is saying about the security of French government debt, and perhaps let's contrast that with how we experienced our little wobble with UK gilts a couple of years ago. The second thing I think we should talk about is we have to talk about the banana, don't we?
We've got to talk about the banana, yes. Definitely.
Listeners might not know, well, if you've been sort of living under a rock, perhaps you don't know what we're talking about here. We're talking about the $6.2 million banana, which was Catalan's conceptual artwork. So we're going to let's talk a little bit about that. Now, that's, I suppose, a nice setup for a podcast we have coming, isn't it?
It is, yeah, because we're going to be joined in a couple of weeks' time by Amelie Serrado from Christie's, making a return visit to Need to Know to talk about what's been happening in the art market in 2024. I'm really looking forward to that. That's going to be
I'll try not to make anything, some judgments on the conceptual art then if we have a proper art expert coming on the show. And then the third one we'll talk about is, should we talk about Black Friday and Christmas and its implications for markets, consumer spending and things like this? Because I've talked a lot, I think, over this year about how we are in a consumer-driven cycle.
Yeah.
And what I mean by that is we're not in a debt cycle, or, what's driving the economy and markets is consumer spending. So I think that's probably the most topical thing right now.
Yeah, exactly. Yeah, no, I think that's a good one. But I guess before we get to those topics, there is another live topic that we probably should touch on. And that's what was happening overnight in South Korea when President Yoon Suk Yeol, I hope I pronounced that correctly, declared martial law. That's since been revoked. But I guess at this very, very early stage, impact on kind of market perception of Korea as a place to invest, how this is going to impact that country.
Yeah, the market's been relatively calm. I mean, the currency market's your classic pressure release valve, and you saw the won sell off quite aggressively in the run up to last night. Given the global nature of currencies, that tends to be your first sort of pressure release valve. So we'll have to see how this unfolds. I mean, the point, I suppose, is that this is the year of political uncertainty. It shouldn't really come as a surprise in this year of all years that we've had a government that's had a razor thin margin have a political event. So we'll have to see how the markets react. Now, it does appear, again, at the time of recording, that although this is obviously controversial in terms of what's happened with martial law and now, a movement to impeach the president, it doesn't look like there's anything inherently unstable in what the outcome will be. I mean, there is uncertainty in the days ahead, but Korea has been here before, and the public have a very strong view on what their democracy means to them. And I think that just cooler heads will prevail. So we just need to get through the next couple of days of uncertainty. But in terms of the market, I mean, the equity markets have been relatively sanguine, I would say, and same the bond markets. For those of you who pay attention to how big Korea is as sort of a proportion of the MSCI All Countries World Index or any other sort of global benchmark, it's a relatively modest component, a couple of percent. Yeah. And most of the debt on the debt side is in those massive supranational companies. I won't mention who they are. You'll be able to probably pick them out off the top of your head. So it's just a little bit of uncertainty.
Okay, all right then. So we'll just have to sort of wait and see what happens there. But at the moment, it seems to be that reaction has been, especially now that things have perhaps been brought to a fairly immediate halt, things perhaps will settle down a little bit. We'll wait and see. But staying on the subject of politics and how that's playing out in markets, let's talk about France. Now, at the time of recording, there is a debate going on in the French Parliament as to whether, and ultimately there will be a vote on, there's going to be a motion of no confidence in Barnier, the Prime Minister. We don't know how that's going to play out. I mean, from what I read, the perception seems to be that he's probably going to lose a vote, or that a no confidence vote will win. I mean, how is this going to impact the French economy, particularly, I guess, the French bond market? I mean, it's not, and this is, I mean, French bonds have been struggling a bit over recent weeks anyway, haven't they?
Well, I'd say almost since the summer. You have to go back and look at the sort of antecedent or the root cause of where this all started. It started really in June after the snap elections. Okay, what happened, for those of you that haven't been following what's happening in French politics, after June, the lower house was essentially split into three. You had the sort of diminished centre that clearly supports the president, and then you've got the leftist alliance, and then far right under Le Pen, whose National Rally is now the biggest force in parliament. Okay, so what's happening in France is sort of an echo of the fiscal warnings that are happening all over the world. It's the investor backlash against soaring deficits, basically. And France's crisis comes, about 2 years after our mini budget incident. And it just reflects this sort of growing, I'll use the word, it's probably slightly hyperbole, the intolerance in global markets for unchecked fiscal spending. Okay, So Barnier, who was appointed Prime Minister, I believe, in September, his principal objective was basically to get the finances in order. Now, that's something that was, I would say, an impossible task, because if you look at the composition of the House, it looked almost impossible to reconcile a budget given the structure of the lower house with these incredibly fractious, effectively coalition. But in step Article 49.3, that should have been my number this week, shouldn't it?
It was nearly mine. So.
Yeah. So Article 49.3 of the French Constitution says that the Prime Minister can basically invoke this article and pass a budget without parliamentary approval. Now, that's what's triggered this, and that's what's triggered all these non-confidence votes that are currently being debated today. Yeah. Right. So what's happened in the bond market? Because that was your question. So French borrowing costs have basically skyrocketed. Okay. So a 10-year government bond yield has been incredibly volatile, first of all, but right now, around about the time of recording, is around 2.92%.
Yeah.
To put that into perspective, that's about the same as a Greek government bond. Okay. Yeah. So you can sort of get the sense of how the market is pricing the uncertainty of basically the French fiscal policy. And if you look at another measure, a popular gauge is looking at the gap between the yield that investors demand to hold a French 10-year and the more, I'm going to put sort of little quote marks around it, the safer German note. And that differential is around 85 basis points. And, that's quite a big spread. Many investment banks are saying that we should get used to kind of 100 basis point spread between French and German debt. And that's something historically is very unusual.
I read that the spread at the moment between French and German bonds it's the highest it's been since 2012.
Exactly, since the European debt crisis. So investors are clearly wary of France's ability to address its deficits. Okay, now what's interesting, I think, is obviously something that doesn't happen in the US. And we talked a lot about that on a previous podcast about how the US has this exorbitant privilege. It issues debt in its own currency. And if you look at kind of, debt to GDP levels, France has, I think, got about 111% debt to GDP. Okay. Now that's above where the US is, but not much above. But the thing is, France is being massively penalised for just having an incoherent approach to fiscal policy. Yeah. So I think the key here, and I will use the same sort of mode of analysis that I use for the US debt situation. When it comes to servicing debt, that's what's important. Now, if you look at the approach to servicing US debt, the US actually has a lot of fiscal headroom. France has hardly any, if none.
Okay. I was going to say, we hear regularly, I think it almost seems to be an annual occurrence. There's a threat of a shutdown in the US because of having to agree a budget each year. Does that happen anywhere else? Or is something special about the US system that makes it vulnerable to that? Whereas, could we get a shutdown in France if this budget is not approved and if there is a vote of no confidence in the Prime Minister?
It comes down to your structure of government. Now, we in this country have become very used to a parliamentary system. Okay, so the government is formed by a party or a coalition with a majority in the House of Commons, and that majority can pass its budget. Okay, so failure to do so would basically equate to a loss of confidence and trigger a general election. So because we have this majority rule, we always pass budgets in this country. Now, presidential systems like the US, that's the easiest one, I think, to contrast. You have president, which is the executive branch, and then the legislature, which is Congress. Okay, so they are separate and opposing forces. They can consist of separate political ideologies, and Congress effectively is the entity that approves the budget. So you need this agreement between the president, the House, and the Senate, which makes compromise essential. And the framers in the US made it that way, and it comes with all its positives and its negatives. In the same way our system comes with its positives and its negatives. France has this sort of semi-presidential system. It shares a lot of similarities with the US system, and it's effectively the same outcome. I mean, you can get the prime minister and the president coming from opposing parties, and you can get conflicts. And in the same way, I suppose the difference in France is you've got this Article 49.3. And although there are ways in the US of getting certain pots of money approved by different subcommittees, there's some peculiarities with certain federal budgets, some of which are controlled actually at Senate and some at House. Anyway, that's all detail. The point is that there isn't really the same mechanism in US and French systems as there is here to just pass budgets. So that's why you always get these impasses. And they're becoming increasingly common as election results are becoming closer. In the last few years, we've had some very, very close election results where typically a budget will be signed off maybe only by 3 or 4 politicians, ultimately marginal politicians. So those of you that remember what we had during the CHIPS Act and the Green New Deal Act in the US, we had, Joe Manchin and Sinema. We had basically 2 senators swinging the entire congressional budget. So anyway, a very different system.
So we'll just have to wait and see what happens in France. I guess from what some market commentators are saying, don't be surprised if spreads widen further between French and German bonds. We can expect the yield on French bonds to go up We'll just have to wait and see. It's all hanging in the balance at the moment.
Yeah, I think I just want to again reiterate this point about the contrast. I think it's helpful to contrast France and the US. So Europe has very different inflationary pressures. It's got a very different budgetary backdrop to the US. Okay, so in Europe, obviously you have rising energy prices, still some supply chain disruptions, particularly in Germany and the German manufacturing center. You've got fallout from the Ukraine war and increased living costs. Okay, that's acute budgetary pressures. That's not an environment where you can just unilaterally raise taxes to service public debt. Hence the market's reaction here, because not only is your economic backdrop not amenable to raising taxes, actually now your political process to even pass a budget is at least temporarily broken. That's not obviously the case in the US. So I think whatever the outcome of this, once we get through the political impasse, which we will, we still have that same backdrop to deal with. And for me, it comes back to debt servicing, because as I said before, if you go and look at OECD measures of ability of governments to service their debt, okay, so if you look at tax to GDP ratios, I talked a bit about that before when I talked about the US deficit. If you look at France is probably the highest, I think it is, in the OECD, the highest tax to GDP ratio, showing you there's very little fiscal headroom. It's about nearly 45% tax to GDP. If you contrast that with the US, I mean, I'm reading off the chart here live, it's sub 30.
Okay.
So you've basically got the ability, I mean, you need the political will, but you've got the ability in the US to raise taxes to service that deficit. Even in the UK, to an extent, you've got some headroom to raise taxes. But in France, no headroom. So it's sort of understandable why the market is looking at it through the same lens as it will look through other higher risk countries.
Yeah. And do we see any concerns around France spreading to the rest of Europe? It seems to be very much contained within France at the moment.
It does. I think I'll give you a very forward-looking blue sky outlook. And I think that what impact this shows is that, France is a pivotal part of the European Union, along with Germany. Okay, it's a cornerstone. And the European Commission has tried to help France a lot by postponing deficit reduction targets out to 2029 due to this government instability. And that contrasts massively with much stricter scrutiny on countries like the Netherlands that have always, haven't had the same kind of latitude that France has. So for me, this is all about EU unity. And I think this struggle might change, and particularly with the composition of the various houses, it might change France's role slightly within the EU. In terms of the broader outlook, I think what it does is create the ECB, again, we've talked about this, haven't we, on the pod? The ECB's had an unenviable task of trying to manage monetary policy across the European Union, with countries motoring ahead like Poland, even Spain to an extent, and the traditional sort of powerhouses like France and Germany in a very different economic state to the peripheral European countries. Now, with what's going on in France right now, French bond yields, and the difficulty from the fiscal side that the government is facing, it just puts the ECB under even more pressure, even more strain. So it goes back to what we talked about with, the plan for Europe, the need for structural reform across Europe. Yeah. And I think we should now recognise that some large-scale initiatives that France has been leading on, like energy transition in particular, now, obviously that comes with a big budgetary price tag. So I think we have to recognise that France might take a slightly different role in some of those pan-European policies. Who knows? We have to wait until the outcome, obviously, today. Let's see.
Absolutely. And then what happens over the subsequent days and weeks. Okay, so that's a little bit of politics. Let's turn now to art.
Well, the banana.
The banana. Yeah. So, I mean, well, as you say, unless you've been living under a rock, you will have seen the sold of Maurizio Catalan's banana taped to a wall. The comedian is called, bought by one of your a topic that we've talked about, a crypto founder, Justin Sun. He paid 6.2 million, I think, with all the fees included, $6.2 million for this work. But I mean, he didn't buy the work, did he? He bought the license to reproduce the work, because obviously the banana's going to rot at some point, and he's actually eaten the banana already, isn't he?
Well, you're getting to like the core of the point here, isn't it? Like what defines art, or what defines the value of anything, right? I mean, conceptual art. So first of all, you're right. Yeah, $6.2 million is an absolutely enormous sum. I tell you what, in preparation for our podcast, which I'm very excited about, I've got a fantastic academic paper I'm reading. I'm halfway through, called "Art in the Times of Crisis." So those keen listeners that want to get ahead of me might want to read that paper as well, which looks at how the fine art market sort of behaves in line with economic crises and other sort of macroeconomic variables. I think we recognize there's a general kind of wealth effect with art, that in those periods of sort of economic exuberance, that the art market can, excuse the pun, go bananas. Yeah. And what we've seen with this 6.2 million banana, I think, is some of that. But the bit that's interesting for me is about, conceptual art places in value on ideas, not materials. And we were talking about crypto last week. And there are a lot of similarities, I think, between the banana and the value that people place on cryptocurrencies.
Yeah, because I mean, and the inflation of both things, because I noticed that the piece by Catalan, there are two other pieces that are part of a series. One of them sold for $120,000 at Art Basel Miami Beach, and the other one's in the Guggenheim. So that's a phenomenal bit of inflation, isn't it, on that piece of work? And I guess, why would Justin Sun want to pay 6.2 million for this piece of work that we know, if we base it on previous valuations, is 120,000? I mean, arguably you'd say it's not even worth that. But I was interested in this because it came up that this was, it made like the piece of work by Catalan, and it drew the comparison with Bitcoin, that they're Veblen goods.
Yeah, okay. So let's get on to Veblen goods in a second. I think that actually, 6.2 million, I think a lot of the backlash of this is and a lot of the writing in the media over the last week has been about the fact that this sale symbolizes inequalities of wealth distribution. Okay, it basically has critics questioning the morality of spending millions on art when many out there are struggling with rising costs of basic goods. But conceptual art's not a new thing, right? I mean, it's been around. Well, I think the Tate bought the pile of bricks back in the early 70s, but it's been around for the best part of 100 years. And ultimately, it's a contract, a recipe, an instruction set of how to create the art. And Catalan's 6.2 million banana is actually, I think, much lower than I think his previous record, 17 million, I think. So why is there increased demand for this? Well, what models could we use to explain it? So you mentioned Veblen goods. Those of you that remember either your GCSE economics or any economics from your formative years remember two types of goods: Veblen goods and Giffen goods. And they're basically the same. They have a backward bending demand curve. So as the price goes up, actually the demand for the good can go up. Now, Giffen goods are quite easy to explain. They're inferior goods. So a classic example there would be food in a time of starvation. There is no amount of money you wouldn't pay for a loaf of bread if you were absolutely starving. So your demand for it can actually go up even though the price has gone up. But Veblen goods are more, I think, about trends and exclusivity. And you find that just because something is expensive, it can actually create its own demand, as opposed to price being your rationing tool. It actually becomes the element that drives the demand.
Because Veblen wrote about this, didn't he, in The Theory of the Leisure Class, and it was this idea of conspicuous consumption, that there's an attraction to products that are known to be very expensive. They have to be conspicuously expensive. It's no good that we're not talking stealth wealth here, are we? We're talking things that everybody knows how much it costs.
Yeah, exactly. And I've tried to reconcile this with my, I'd say, skeptical view of cryptocurrencies. Okay, so both of those entities, both of those objects, I'm struggling with the definition myself here. Both of those investments, let's say, have no real intrinsic value, no real inherent value. Okay, a banana isn't worth $6.2 million in the same way that a cryptographic a cryptographic entitlement to Bitcoin isn't really worth $100,000. But I suppose the difference here is the nature of art and its contribution to society, culture. I mean, I would say that Catalan, irrespective of listeners' views on conceptual art, which I imagine are going to be polarized, you can make the argument that artists are making a contribution to the tapestry of art and culture of society, and therefore there is a value in the contract associated with that. But do you remember my argument about cryptocurrency, that actually it is a really lousy currency?
Yeah.
And I'll go even further and say I'm not sure, even though you might have some strong libertarian views on crypto and a decentralized financial system, I still think it's a stretch to say cryptocurrencies are a contribution to the fabric of art and society and culture, unless you're sort of an anarcho-financier or whatever the term is. It's a very difficult argument, I think. So I think there are some good arguments that, at least while the trend lasts, that the banana can be worth $6.2 million. Well,
apparently, because Justin Sun ate the banana on stage and he compared it to a crypto asset, saying the real value is the concept itself.
There you go. And there you go. I'm not sure I'd pay 6.2 million, but I imagine the shop or the market stall that sold the auction house $6.2 million, if they knew what it were going for, I reckon they would have bid up their price.
Yeah, but apparently I did also see that he's actually going to buy a whole load of bananas from the street vendor in front of Sotheby's, where the person who actually sold the bananas to be used in the work. So he'll benefit from it. So that's good.
Well, I'm looking forward to talking about art and the economics of the art market in a couple of weeks. So we'll save. Maybe we'll ask our art expert her opinion on it.
Yeah. Definitely. All right, then. That brings us to our last point, which is it's that time of year. Well, it's not quite the time of year yet for the Santa Rally, is it? We're early December, but I guess thoughts on the Santa Rally. Is it a reliable kind of, I don't know what the word is, sort of measurement metric? How reliable is the Santa Rally as a kind of, do we often see markets go up in the run up to Christmas, and what's driving that?
Well, there are some patterns. And I think it's pretty important this year because the health of the consumer and the health of consumer spending is what all analysts are looking at right now. And the period between Thanksgiving and Christmas isn't just this time for celebrations. It's actually a pivotal stretch for the economy and stock markets.
Yeah.
So consumer behavior, retail strategies, market trends, they all drive corporate revenue. Corporate revenue influences economic metrics and earnings, which ultimately drive sort of equity returns. So it is really important. So I talked a little bit about the origins of Black Friday, which is traditionally, your start of the holiday season. That's when you get these massive discounts. And if you go back and look at the impacts, we'll start from Black Friday and let's work the way through to Christmas. You can see I looked at some data from 2007 to 2017, and you can see that retail stocks in the S&P 500 deliver returns of up to around 5% during this Black Friday period, relatively consistently, intended to outperform the indexes, typical 3% average during that same time frame. And I think that's interesting, but really this is more about the temperature read on the health of the consumer, and then the market implications from that, because there's two aspects to it. There's just fundamentals of earnings, which is what we know drives equities, but there's also the idea of investor confidence and the more sentiment side of it. So what you tend to see in the data is that disappointing sales figures can weigh on sentiment. The Santa Rally, which is just a term for the tendency of equity markets to rise during the last 5 trading days of December and the first 2 trading days of January. And if you go look at the deep history of the S&P, you can see that the S&P 500 gained on average, I think, of around 1.4% during that period. And that rally happened about 80% of the time since 1950. So a pretty good hit rate. But, those periods over Christmas, I would encourage investors and listeners to always remember how illiquid markets are. And just because something has happened before is by no means certain it will happen again.
It was actually Yale Hirsch, wasn't it? He was the founder of Stock Traders Almanac, who first coined the term in 1972, I think it was. and he identified this trend. I guess, and I saw various different reasons behind it. Obviously, you've got a massive increase in business activity, or people sort of going out and shopping and spending money during the Christmas period. But you've also got people perhaps spending bonuses at the end of the year. You've got people sort of closing off their books at the end of the year. There was another argument that institutional investors have kind of shut everything down for this period, whereas retail investors are still very active. They tend to be more bullish than institutional investors. Are those all kind of reasonable rationales behind the Santa rally?
They are. The academic research that I've looked at shows, well, it really splits, I think, into three buckets. So you've got consumer spending. So you get elevated holiday shopping that drives, we know that drives GDP growth, corporate profits, and indirectly influences stock valuations for those reasons I mentioned earlier. But there are also other things, tax strategies.
Yeah,
so,
of course.
Plenty of investors engage in obviously it depends on your country and when your tax year ends, but there's a number of investors that engage in year-end tax loss harvesting and doing portfolio adjustments, things like that. So you can contribute to trading activity and market gains that way, which is a little bit of a false signal. And then you've just got psychological factors, the kind of behavioral economic side, holiday optimism. People enjoy Christmas, they're sitting at home, and particularly now when they might be bored in that period between Christmas and New Year's, they might go on and ultimately trade. So when you look at the academic research goes in and looks at some of those factors, and then it looks at the sectoral impact from those factors. And the focus is obviously on retail stocks. But the broader index can benefit as well. I think if we look at this year, like what does the market trend show us this year? What does the 2024? Because we've just had Black Friday effectively. Yeah. And as of early December, the S&P is up nearly 30% year to date. So I think the data that is coming, some of this stuff is coming out live, but particularly if you look at sort of Amazon and Walmart Black Friday spending data, it looks really strong. You've had some very strong retail performance, particularly in e-commerce. So those companies I just mentioned. And I would say that, based on the data, and again, it's just one data point, but there is no reason to think that the consumer isn't spending. If you go and look at the retailers' use of limited sort of promotions and one-time discounts, they've been more limited this year. So I think retailers realize they have pricing power. The consumer is still spending. So these are good, positive indications the consumer's healthy.
And this is not just something that's exclusive to the US, is it? Because I saw also, I think the DAX has reached new highs this week, the week of recording, and even the CAC 40 had also had a really good week. I mean, despite what's happening in the French Parliament at the moment. So it's not just a US phenomenon, is it?
No, it's not. And there's been obviously an incredible sentiment behind the market this year. I think we as we get to sort of this stage in the economic cycle, obviously now I've seen the market hang off data points it wouldn't traditionally hang off. Everyone now recognizes that things like non-farm payrolls have a disproportionate impact on equity markets, so unemployment, and also consumer spending as well. So it explains, I think, a lot of the sentiment and a lot of the movement in the market, particularly when the valuations are backed up by these positive earnings. So if you think about it as sort of leading and lagging indicators, your lagging indicators, your sort of non-farm payrolls, which is often revised. But a good leading indicator is literally live consumer spending. Now, many of the banks in the US that have divisions that issue credit cards and they have ways of measuring in real time consumer spending. Then we get the e-commerce data from Black Friday, which we've just had. So you get this kind of coincident to leading indicator saying that the consumer is really healthy. And then obviously time will tell once we get the bigger macro data coming out. But it does look, it looks very robust.
And we haven't even talked about the Trump trade, which I think we're probably going to talk about next week, aren't we, when we do our look back on 2024? Because I think this 2024 was always set out to be a big year, certainly as far as elections are concerned, and as far as geopolitical events is concerned, those are still playing out as we hurtle towards the end of December. So lots to reflect on.
Yeah, we have to go through. Why don't I go through all the Trump trades? Because the measurement problem, as the physicists would say, is really acute here. If we looked at the Trump trade in September, we would have been very disappointed. If we had looked at it the day after the election, we would have been very elated. Let's see where we are now, because I know off the top of my head, and I've seen a few of these data points the last week or two, It's not all roses. Some of the Trump
Okay.
trades haven't persisted or haven't lasted, but a week is a long time in politics and a year is a long time in markets. So let's see.
Okay. All right then. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David, for joining me today. Thank you for listening. Until next time on Need to Know, bye for now.